All right, guys, welcome to our Tuesday live stream. We were trying something new today. I just hit live on Instagram. Today we're going to have John Hoffman will join me. He's going to be here within about 10 minutes. But we're going to be talking about the current state of home foreclosures. And John just went to a big conference. It was a distressed asset management conference. It was in Dallas, Texas, and where they were going over, all of the changes, the updates. As of the end of September, the waterfall, the foreclosure moratorium for FHA ended, and delinquencies are up. And we're going to find out what is going on with mortgage foreclosures. It's something that we haven't seen for about 5 years. I mean, there has been an uptick in home foreclosures. We are starting to see where the auction sites are presenting these houses, and even locally here in Maryland, we have local auctioneers that are now dealing with some of this foreclosed inventory, but it's still very light. And we know in the industry that this is a big inventory problem because foreclosures through the years are just a part of life. For whatever reason, someone loses their job, their financial situation changes, their health declines. For many different reasons, every single year, we see a certain percentage of mortgage foreclosures. And not all of these properties are distressed. So when you think about someone losing their home, now we really have to look at, at the particular situation and say, well, just how long has the borrower not been paying their mortgage? And in many cases, it's been 4 or 5 years before the bank actually decides to foreclose on the property. And if you've been watching our, podcast in the past, we know that Fannie Mae and Freddie Mac, which are two government-sponsored enterprises, they have been under conservatorship by the government, where they took them over in 2009 during the 2008 financial crisis. But between FHA and Fannie Mae and Freddie Mac, that makes up a very large percentage of homes that are either backed or insured by the government. And we know that through the pandemic, foreclosures were halted. And one of through this moratorium, there was over 1 million households that actually went through some type of loan modification. If not just one time, the borrower has gone through 2, 3, 4, 5 different modifications where all kinds of things have happened to try and help this borrower stay in the house. And what that has done, in a lot of ways, is it's exasperated the problem of what we might find out to be a lot of distressed property, because we know that for the most part, when people aren't paying their mortgage payment and the servicer steps in and continues to pay their homeowner's insurance, their property tax bill, because they need to be paid, the borrower's not fixing anything. So what we learned going through the GFC, the Great Financial Crisis, is that many of these houses that ultimately were foreclosed on, millions of them, the houses were in complete disrepair. And the only ones that were really buying these properties were investors. And then what we've seen since the 2019, the pandemic, or 2020 pandemic, is that people not paying their mortgages, we're falling into that same type of distressed property. Things haven't been fixed or worked on for 4 or 5 years. And what they're doing is, and what they have been doing is, Fannie Mae and Freddie Mac have been bundling up these defaulting loans. They're either called a NPL, which is a non-performing loan, or an RPO, which is a re-performing loan, RPL. And what they've been doing is selling those off to investors in bundles. And again, this is stopping the inventory from hitting the market so that owner occupants can buy up this housing stock, and it's preventing that from happening. So John's going to tell us exactly what's going on, what he learned in this conference. And John is an REO broker. He's in Chicago, and REO means real estate owned. So for years, this has been his specialty, working with the banks in selling this distressed inventory. Now, just to give you some updates, we are streaming live, and we will take comments and questions. So if you want to comment your questions in the live chat, feel free to do that. We'll try and get to as many as we can. But I do want to say that we also have a poll, and Joe, if you could pull that poll up right now, and I just want to kind of go over it with you, because a lot of people are thinking that there's just going to be another workout, that they're going to continue to kick this can down the road. No one wants to see, especially, in D.C., they don't want to see thousands or millions of people displaced from their house as a result of a foreclosure. It will exasperate the homelessness population that we have. For a lot of people, their credit is bad because they haven't been paying their bills, so they can't find a place to rent easily. They have to fill out credit applications and things like that. And so it really puts someone going through a financial crisis in a real potential hardship if they don't have a place to go. So the poll here, and hopefully we've 59 votes already, but if we can get you to vote on this, FHA ends the Biden era COVID-19 loss mitigation waterfall. Now what? Expect major foreclosures, expect more workouts, or it's a nothing burger that there's low delinquencies. And right now, 69% of you are saying expect major foreclosures. And here's the man of the hour himself, John Hoffman. Welcome back to the show, John.
What's up, man? I'm in like that. Wow, that was quick. I just see polls about foreclosures. It's like I'm there.
Well, you're the man. So we're expecting a lot of good information from you. Just kind of explain to everybody. I told everyone that you went to this distressed asset conference in Dallas, Texas. You just got back from that. Give us an overview of what that was like.
Well, I mean, the attendance of that, I used to go to that back in the actual crash in '08. I went to that till probably around 2018, 19. And it was actually there was a ton of people there, and it took over the whole hotel. And now, I think I'd sent you stats on it. It was about 400 agents registered, and they had like 2,500 of them back in 2016. So that's how far the mighty have fallen, But in the end, really, Equator was there, REO Network. Those are the main REO-driven sites that you can go to try to get REO listings. And all they were doing was pumping for, getting agents to register. Hey, come register. But none of them had a clear path forward as to where anything was coming from. But I think the biggest telling thing that I shared with you was that in the HUD meeting, which was FHA, VA, and all that, they basically straight out told us 2026, 2027, foreclosure activity is going to spike high. They said that most of it's going to be driven from the loans originated from 2022 to 2024. And I had actually challenged one of the speakers in that, and I had said that, I go with the gates coming down October 1st for the FHA workouts, what kind of mess do you see coming? And I told her, I said, FHA delinquencies are like 10 or 11% right now. And that's not including all the people that are getting these off on the side workouts. There's a lot of like, well, what's really delinquent, But she said, oh, no, the delinquencies are 4%. It's like, well, I don't know, Mortgage Bankers Association, I'm like going, no, they're saying it's 11%. So, that's a pretty good source. And she goes, well, I guess it just depends on where what source you use. Okay, let's just, move that along. There's nothing to see here again, Yeah, so anyways, I don't know if that answered your question or not, but.
Well, so the conference, basically, real estate agents, they pay to go to this conference. They pay to be certified to get these REOs handed to them, right? I mean, that's what they're there for. And I mean, in a lot of ways, it's probably a big money grab.
Oh, it is. It's huge money grab, and it's been a huge money grab for 4 years, really. I mean, I still have my account set, and it's like auto debit every year. And, and that's why when I go to these conferences, you can finally nail them down with the pitchfork, like, hey, it's been 3-4 years and they've always, they always have something coming, but you never see it. But, right now, though, it's so fertile that moving forward, the mess is on its way. It's completely laid out in front of you. Anybody who's like denying that or doesn't see it is just judge, they're just, they're pumping it for their own good of whatever, their stocks or whatever the hell it is. But, it's all in front of you. It's all coming right now,
Well, I mean, one of the things the administration wants to do is privatize Fannie Mae and Freddie Mac. And so I guess if that could affect the IPO if there are high delinquencies. I mean, do you agree with that?
If you looked into that, though, he wants to privatize them, but with their backing. So is it privatized or is it not? Basically, they're going to privatize it so everyone can buy into it, but they're not. But if they get into trouble, they're going to step in and save them. So it's all just more of the same. Just keep, they want to just keep pumping keep the hot air in the balloon, keep it going. None of our leaders want to come out and go, look, we're going to have some tough times. We need to, it's going to be tough. We're going to have some foreclosures. We're going to get this, but we're going to get these asset prices stabilized so that it's normal again. Nobody wants to do that. That's like in Chicago, for 30 years, our favorite quarterback for the Bears was the guy that was on the bench, because the guy who was in there couldn't do it. And every presidential cycle, it's the same way. It's like, well, oh man, look how bad inflation is. I'm going to save the day, and and they just get in, and then they start pumping it with more air. I don't know. It's insane how all these ideas, and I think I kind of sent you something about, he wants to. Trump wants Fannie and Freddie to start building houses. It's like, well, they're not even a builder, first of all. And what is that going to do?
Yeah, well, October 5th.
That's assuming that they can build them for cheaper than what they can build them for now. How are they going to do that? Unless they're going to build one bedrooms,
In this Reuters article, October 5th, Trump calls on Fannie and Freddie to get big home builders going. And I think the biggest, you sent me this earlier today, President Trump on Sunday urged U.S. mortgage financing companies, Fannie and Freddie, to get big home builders going, saying without providing evidence that U.S. home builders were sitting on 2 million empty lots. That's a record. Trump met in August with top U.S. bank executives to discuss the administration's plans to privatize the firms, which guarantee over half of the nation's mortgages and have been under federal conservatorship since 2008 financial crisis. 2 million lots. That's a lot.
But again, so what? I mean, it's until you get the cost of this stuff down, none of this means anything. Well, what are they going to build a whole slew of homes? That's going to drive inflation up. How are they going to do that? Please tell me. I'd love to hear it.
Well, people aren't buying.
Right. I mean, nobody's buying. I mean, the rates, they're like, oh, the rates. And, the whole thing. It's like, oh, we got to get the rates down. No, the rates have come down from 7.5 to 6.2. Now they're back to 6.4. Of course, they were supposed to go lower when he lowered the Fed rate. And of course, they just went up. So that was all the Philippines. But it's like, it's coming down now, and it's not helping anything. It's getting worse.
Well, we have builders that have been offering rate buy downs for years.
Oh, Todd, they're offering, they're offering the buyers like a $10,000, Home Depot card or whatever that other house, design your house thing. And it's like, that's just them, and I think it was in August that the builders had a big month, or September, maybe it was September. I think in September they had a big month. It was like, oh my God, the builders are rocking and rolling. Well, that's because they're giving away the farm to get rid of these properties. It's not like all of a sudden people are buying them. No, it's because people are buying them because they're getting so many, things involved in it that it's like their purchase price is probably $550 and they're really paying like $450 for the house. you know?
Let's talk about the FHA ending the COVID-19 loss mitigation waterfall that ended at the end of September. We could take a look at this here. Some of the highlights: permanently sunsetting the COVID-19 loss mitigation options on September 30th, moving up the effective date of the new permanent loss mitigation options to October 1. It was originally set for February 2nd, 2026. Continuing the suspension of FHA-HAMP and sunsetting the program effective September 30th, 25, extending the time on the eligibility of a borrower for a subsequent permanent loss mitigation option to every 24 months from once every 18 months, and canceling the scheduled increases in borrower compensation under FHA's pre-foreclosure sale program, deed-in-lieu of foreclosure, disposition options, and cash for keys incentives, maintaining the current amounts. Tell us what's happening with this. What does it mean when they're ending this waterfall program?
Well, I mean, it's basically, I mean, we've gone over that a little bit with, these people keep getting these workouts and they get them every year. I mean, we're mailing a lot of them. We've closed 3 deals of people that were just literally going crazy on getting these workouts. And what it means is that now for every 24 months, and you have to be able to prove you can pay, from what I'm told. Okay, that could be wrong, but so you get one workout in 24 months. And let's say you're 6 months in from October, you're in whatever that would be March, and you get a workout. That's all you get till the next October, or a year from October, and you have to maintain that payment. I mean, it's not like, well, okay, I can't do it anymore, we'll just step in. From what I can tell, and I don't, again, this is government at work here. I mean, they're basically now they got to stand on their own 2 feet, which is what they should be doing. COVID's over 5 years ago, or 3 years ago, whatever. Time to move on. Get these people, if they can't pay, and I'm not saying you don't give them a workout. Give them a workout. Great. Can't do it, you're out. It's time to get inventory back to a normal pace. And I was going to tell you that too, Todd. It's like, what's his name? Trump called for, and this isn't political at all. I mean, I don't buy into any of that stuff, but it's like, he says he might call for a housing emergency. All right. So I took the liberty of looking up the definition of emergency. Okay. It's where something that happens that causes desperation that comes out of nowhere. Okay. It's unexpected. It's an unexpected problem that you run into. And it's like, well, so how is it unexpected that, we have this housing is such a mess? I mean, part of most of it's your problem, because the people that are staying in these homes that you don't bother moving these along and keeping the inventory moving, that's your problem. You guys have caused that. And then keeping the rates too low, you guys have caused that. I mean, it's an emergency. No, it's not. You guys have been at the wheel of this truck going over the cliff the whole time. But that's just their way of going, well, we got to find a way out of this so it doesn't look like we did it, So anyways.
Tell us about.
Go ahead.
Tell us about what you learned with the FHA bidding. What does that mean? You had said that borrowers, if they buy their house back or redeem their house, that they would have to pay more than what they actually owe. So what happened? Take us down that process of, specifically with FHA. How does that foreclosure happen? And kind of give us the steps of that, and how borrowers to redeem their house end up paying more money than they actually owed.
Well, basically what I learned, and I keep in mind, this is really loose info. I would almost recommend if you could get like Melody on, she might have more info on that. I was trying to hunt her down, but I couldn't find her at the conference. But basically the lenders, when the guy's in foreclosure and they go to the auction, from what I know, HUD is telling the servicers, you need to bid what the property's worth, not a nickel over what the guy owes. And I wasn't really clear on like why they had to do that. I think because there was costs involved that they wanted to recoup outside of that. So they're basically telling the servicers, for you to get the insurance, you need to go in there and pay, if it's worth 550 and he owes 4, you pay 550. But the problem was that what the servicers were saying at this conference was that now the guy's showing up with a suitcase full of money going, here's my 450, where's my house? And they're going, no, you owe 550 because that's what we bought it for. And so they're getting into this legal, problem with it. And then the other thing too that I thought was interesting was that, they're bidding on them, and there's literally like, if they do anything wrong and through the process of the foreclosure, they're liable. I mean, and they were saying, a couple services were saying, we're not even bothering to go to the auctions and get these because we wanted more clarity on what's going on with it. So
what happens if they don't show up at the auction?
Yeah, well, they're basically, they're not foreclosing on them, even though the guy's in it hasn't paid. They're not foreclosing because they don't want the stigma of having to go, and if they're wrong, because some of these, it's really delicate. I mean, it's from what and like I said, I'm kind of foggy on the whole thing, but it's like there's a lot of intense stuff going on with the servicers, and the servicers are basically, they all are sitting there going, we're all our money's tied up in bidding on these properties. And so we're stretched, the servicers are like, we're stretched to where, because we have to take these properties back, and then we sit and wait 6 to 12 months to get our money from the insurance. So, our capital is tied up in pulling these properties back. So that's why they're like, well, we'll just let that sit. It was very complex. I got as much as I could out of it, which I kind of sent you that. But, I like that FHA thing. I think Melody might have an angle on that. I mean, I don't know for sure, but, it's craziness. It's complete crazy. And it's like in that conference, it's like so much screwy stuff coming. You're learning so much stuff about how many layers of bureaucracy there are in these properties,
Well, let's talk about the value of a house, because let's face it, one of the things that I'm sure no one wants this to happen, for new comparables to be set. So if a house is worth $550 in move-in condition, the servicer needs to bid what the property's worth. Who sets that? Are the servicers even allowed to go inside the house and see the amount of distress to determine, to do some type of opinion of value?
No, they just take those at auction. And really, what those are derived from is the BPOs. Because like I've told you over the years, you just do BPOs on these.
But they're drive-bys.
Yeah. But I mean, they basically use like a metrics of 4 BPO values from 4 different agents, and maybe a Zillow price or whatever. But that's pretty much what they do. That's how they come up with that. I mean, they use a rough number and they go in there and into the auction and do their thing. And
that's what they have to pay. So what that does is keep the comparable sales up. So people can understand, if you have a house in a subdivision that sells for, and if a servicer, whoever buys that house at an auction, that's the price that's recorded for that home purchase. It doesn't matter what the previous purchase price was of the borrower even. Right. That is a new comparable. So essentially what you're saying is they want to hold these property values high.
Yeah. I mean, in a nutshell, yeah. I mean, I don't think that's their intent. I mean, I think they're, from what I was told, they're trying to recover more losses that they have on these properties. That's why they're doing it. Again,
John, if they don't have many, if what they're telling you is that only 4% of the FHA loans are in delinquent status, then that doesn't make sense. I mean, you cut bait, you clean up the problem, and you move on. If that truly is the case, it sounds to me like it's a lot bigger problem than what you're hearing.
It is. It's an extremely a lot bigger problem. And to your point of new comps, the people I've had that have had the workouts that have sold their properties in the last 3 months, those are new comps, low comps, because we're just getting him out of there because he's 12 months behind. He's had 20 workouts. The house is a wreck. those are what's coming in now to the new comps. But yeah, I mean, maybe they're keeping it up. But the whole thing is awash with, just complete nonsense. Yeah, it should be foreclosed, move it in, clean it up, whatever you're going to do with it. Boom, it's an REO on the market. That's not happening.
Explain a servicer's role, because a lot of people watching, they may not understand. What does a servicer do?
Well, the servicer basically gets the properties. You buy the house, and whoever finances it, they usually sell that. And they'll sell that to servicers or whoever's going to take over that property. And then the servicers will make your tax payments, make your insurance payments, make sure you're paying your payment. And they work with you. The servicers are working with you to maintain your house, and you make your mortgage payments to them. But when the thing goes bad, then the insurance that is covered on that mortgage, that requires the servicer to go get that property out of auction, out of the foreclosure, and that's how they get their money in the insurance way. But yeah, the servicers are basically just, they're maintaining that property mortgage. Okay. And they work with you to, make your payments. If you're not, they work with you to come work out something to keep you going. But, like we've been talking, they've been working out everything for years now,
The servicer also has to pay the insurance if you're not paying your payment.
Yeah.
And they have to pay the tax bill. So where's that money come from?
It's coming from the servicer. And that's what, at the conference, that's what the servicers were complaining about, that they've got much, because they have to make those payments and then get their money later from HUD. Well, and it was mostly HUD we were talking with. But, that could, and they were saying it takes 6 to 12 months for them to get their money out of it. So they're making, keeping these things afloat. And then later on, you get their money, but that can run super late. 12 months later, you finally get paid for a guy you were keeping afloat a year ago. It's the whole thing is just, it's completely nuts.
Do you think we're going to see a massive influx of foreclosures?
Absolutely. Next year. I keep saying it, middle of next year to late next year is when it'll be front page news. They're going to probably try to step in when this FHA thing goes south, because you're not going to hear nothing until probably March next year. You'll probably early in the year, you'll start seeing these start to fall over and tip over and stuff, and then it'll catch fire because now people are going to try to sell. Now they're going to go, oh crap, I've already used my one workout. Well, I got to sell, and now you're going to see an influx of properties coming on the market. What's that going to do? Drive the prices down quick. I mean, I'm already seeing it, and we're not even there with the foreclosures yet. I mean, foreclosures are up, 18% from 6 straight months. They're up from 18% from a year ago. Yeah. And foreclosure filings are up 6 straight months. And that's not including all this FHA and Fannie stuff and Freddie stuff. And, and another thing too, it's like the job thing. The job thing is what's really, I think that's like the main element. That's the canary in the coal mine. And, back in March, remember Doge, 216,000 job cuts. Well, those people all got 8 months of severance. Well, that runs out next month. So those people all become unemployed now. Well, that hits the sheet, I'm
starting to see a lot of houses hit the market where they purchased the house in 21, 22, 23, and they're trying to sell. I just looked at locally here in Maryland, I just looked at a short sale, and it's $360,000 is what they're asking for the house. The borrower paid $340,000 for it 2 years ago. They have vacated the house. It looks like a disaster, and it's probably worth $200,000. It needs complete renovation. And it's private water, private sewer, so there's a liability there, because any investor to come in there, who knows whether the well's good or whether the septic's good,
right?
And it's a mess. Let's take a look at that poll.
Yeah, that poll looked pretty heavy duty. When I came on, it looked like, wow, it's runaway.
Yeah, let's see what people have to say here. 156 votes. Almost 70% are saying expect major foreclosures, expect more workouts, 15%, which is what people feel the least confident about, and that it's a nothing burger low delinquencies is 16%. Are you expecting that they'll come out with another workout if foreclosures really spike? Or do you
They
think they'll
will
just let it happen?
they will do anything and everything they can to keep it out of the system. I mean, the problem I see, which I'm hanging my hat on, I have bets with, investor guys I know and stuff, middle of next year, late next year, because they're going to run out of rabbits to pull out of that to keep it afloat. The jobs, I mean, it's just the jobs are crap. People are losing their jobs. And I mean, just talking to people, I don't know if you just talk around and, talking to people and they're like, yeah, I'm getting real nervous at work because they said, well, we lost this or we lost that. And it's like, that's when you start seeing that pain, and you can't do anything about it. You can't just keep, refining these people. You can, but if you're going to make this where they have to actually stand on their own 2 feet for at least a year or two, it's not going to work, because most of these people that have these 7, 8, 9, 10 workouts in the last 4 years, and I've got them all. We're mailing them every week. It's like they should already be gone. And one of the things too that's kept people, and there's people that are sitting on a brink going, well, my house is, I know it's worth 350. That's just their number that Zillow tells them. I know it's worth 350, and but I don't have anywhere to go, and I know I got equity, so they kind of hold on, and everybody keeps holding on and holding on. And what's going to happen is, like it's happening now, as you're getting these new listings. Boom, well, that's cheap. Why is that? Why did they list that? That seems kind of cheap. Boom, there's another one. Boom, and that starts dragging that down. So these people going, hey, I'm worth 350. Now maybe they're worth 3. And that's, I know that's one of the things that's causing is people just don't have anywhere to go. They're like, I'm holding on for dear life, man. Give me another workout. I'm sticking around. Just 6 months, I'll be able to turn around. They're not going to turn this around. I mean, most of these houses, I've sold 3 of them in the last 4 months, 5 months. They're all wrecks. I mean, I get there and they've been staying afloat, not paying the mortgage, giving them workouts, and the house is a wreck. They don't have the cash, and with the insurance, the taxes, the HOA fees all going through the roof. I mean, HOA or homeowners insurance now, what are you seeing? Is it like $2,400 a year for a house?
I mean, it depends. It could be $7,000 a year for a house. It depends on the value of the house.
Yeah. And 8 years ago, it used to be $600 a year, so now it's like, where did that come from? And that's what I'm seeing too, is like people that have owned their house for like 6, 7 years. And they're like, John, just get me out of here. I can't afford it anymore. And he's got equity, but the house is eating him alive,
Talk about zombie properties. A lot of people don't know what they are. Explain what they are.
Which ones?
Zombie properties.
Oh, zombies. Yeah. Those are basically, vacant homes that haven't been foreclosed, or some of them have been, I guess, but they're just stuck in the system, and they don't. And one thing, that the conference we were learning was that those are some of those they don't want to take those back, because they don't want to be wrong in how they process that foreclosure. So those just sit and they turn into blight for the area. No one's cutting the grass because they haven't moved through the system. And so, a lot of those too, a lot of them too, the servicer will just go, okay, it's vacant. Let's go in and we'll rekey it, cut the grass, we'll put it on the grass cut list, and they'll maintain it until it gets to where they move it into foreclosure. But a lot of them are just sitting there. They're literally not doing anything with them. But some, a lot of them are cutting the grass and stuff, but still it's a property that is never going to look great when you have field service companies taking care of it. They're just keeping the city off their back, But yeah, that was a big deal in that conference, was that those are some of those where they're just afraid. They're afraid to, because the laws are so tight on the servicers that they do something wrong. They're like, we could be held liable, I mean, like personally, which is nuts when you think about it. I mean, the whole system of housing is just this convoluted mess of, and I mean, we need to build more homes. No, you don't. You can't even afford to build no. I mean, builders want to make at least some money on this when they build it. And with all the regulations, I mean, where I live, the regulations are ridiculous. You get to build something, it's like, it could cost you $100,000 just in joke fees, just to get the thing kicked off. So yeah, I mean, the zombie properties, that's their biggest concern right now. They feel like they're going to be held liable, so they're letting them sit.
So when somebody vacates a house, it becomes hard to determine whether they have truly vacated it, whether they're staying
Correct.
somewhere else, whether they have their personal belongings still in there. And what you're saying is that it's illegal to rekey that property if it's
Right.
not in fact vacant. And I mean, there could
Right.
be criminal prosecution on.
That's what they're saying. They're like, we're worried because, so we're just like, yeah, we're going to leave that over there and we'll wait. And they're trying to get more information on how to handle these. It's like, okay, well, that's another backlog. We can just set over there and wait for that to come through. Yeah. I mean, and I've had properties during when I was busier in REO, where I had one in Aurora that we went to the house, the gas was locked out, the water, call the city, the water's off, break in, there's a family of four sitting there. We're like, what in the world is this? But that was, I mean, that's what I mean. You just don't know,
And it can be dangerous too, I would imagine.
Oh, for sure. Yeah. I mean, believe me, we, joke about when we're going to find the first body, and that's not a funny joke, but it's like, yeah, it can be dangerous for sure. It's been dangerous. Just doing BPOs has been dangerous,
Tell us about that.
Oh God, I had one Oswego, Illinois, out west of me, and it was a drive-by. And these guys know when they when you're BPOing them, drive-buying them, and they order a bunch of them, so they know people are driving by taking pictures, and they catch you, And this guy came out running out from his backyard. I took off. I had my pictures. I took off. He caught up to me at the light, and he's like, you ever come, you come near my house again, you're going to be in for, it's like, great, dude, I'm just doing my job here, man, filling in the bank, I mean, and that's where some of that, where I get pissed off at the banks, because it's like, you guys string this out too long, and these guys get comfortable with this. Like, the evictions, they're like, this is BS, it's like, dude, you haven't paid in 4 years. We offered you 12 grand to move 2 years ago. Why? What do you mean this is BS? This has been a free place. You didn't even have to pay taxes on it, And that, yeah, I mean, that's part of the other problem, is that, they're causing entitlement issues big time with these properties, and that's where it's just, and that gets dangerous. I mean, there's been, there's been stuff in the news I've seen. I mean, I follow it I'm kind of tuned into it, but where guys were shooting through the door and stuff at the cops and people trying to evict them. It's like, yeah, and I mean, that's the problem with that, is you guys are making this way harder than it needs to be. We need to get back to common sense. Hey, you can't pay, great. Let's give you a workout. Let's get back on your feet. Boom. A year later, year and a half, that don't work. Then, sorry, man. Let's call it a day. Sell it. Hopefully, you get some money out of it and move on. And then we're off to the next one. But yeah, it's the whole thing is just, it's nuts, completely nuts.
What do you think if somebody stopped paying today their mortgage payment? How long would it take for them to be foreclosed on?
Oh God, well, it's depends where you're at. Illinois is probably 2 years, 700 days. That's the last I saw of it. I think some states are probably maybe 9 months. But Illinois is hey, no worries, and to evict them that could be 6 to 12 months to evict them, So even when you get foreclosed, I mean, that's why they have a life cycle of set like 2 to 3 years right now, and that's like minimum, that's like minimum.
When you were on our show last time, you were talking about the bank calling you up for a BPO, which is a broker price opinion. They want you to drive by the house, take 5-7 photos, what have you, right, give an opinion of value, what you think from a curbside approach, what you think the property's worth. You said now they're wanting you to contact the borrower and arrange to go in to take interior photos. Has there been any updates with that?
It's still the same. It's steady. I mean, it's definitely, the BPOs are the drive-bys are like, I mean, I can't even keep up with them. I don't do them. We mail them, but I don't do them because it's just, I mean, you couldn't keep up with it. I mean, I get 27, 37, 40 a day depends on what day, but it's like, yeah, I mean, and the ones that I think are tight are the ones they're sending me into. And you know what else I'm getting a lot of BPO requests from is bankruptcy attorneys, because these people are going into the court and they're, what's my house worth? That's the first thing they want to know. And that's picked up. I used to do that back in like 08, 9, 10. And that died off after like 15, 16. And now those bankruptcy attorneys are back now wanting interior BPOs on, so they can go to court and figure out what's going on with this bankruptcy.
Are you having a hard time getting a hold of the homeowner to go in and take pictures?
No, because they're the ones that are desperate. They need it. I mean, they're begging me to come, because if I don't show up, then they're not getting their workout, But
what does the inside look like?
The insides they're usually pretty beat up. I mean, I get a couple that are, well maintained, but most of them are it's just neglect because they can't keep up with it,
Are they dirty?
Yeah, they'll be like, I'll get in there and they'll be like, oh, there's the AC unit, but it doesn't work. We've been kind of, looking in, it's like, okay, I mean, and they can't afford it now. I mean, what's an AC unit now? What was it in 2019? 2,200. Now it's 45, $5,000 for just a condenser, Are
you finding it's in disarray? I mean, is it dirty? Is it, what are the living conditions like, aside from things being distressed and not working?
Oh, I mean, some of them are awful. I mean, some of them I can't get a good picture without having a pile of stuff in front of me, I mean, yeah. I mean, the spectrum on it is huge. I have some that are great and they're just like, oh, please, he lost his job and whatever. And then the other ones are just, you can tell it's like the end is whenever the bank gets around to pulling the trigger, the end is near, for sure.
Are you aware of the balance when you're going and doing a BPO?
No, I mean, I can look it up. I mean, I like I said, I mail a lot of these, and right away I do, because I have to pull history on it when I'm giving them a BPO anyways, and I can see the mortgage history. And that's where I see a lot of those workouts in there, that they keep getting them. But you can tell that because, the people, they buy it for $400 in 2022, their mortgage is, $380. Okay. And then, after 2022, they get $15,000, $30,000, $15,000, $30,000 tacked on. So now they owe $440, whatever numbers I'm thinking of, but $440, $450. But the good news is since 2022, it might be worth $475, but now that's starting to teeter now where it's, because now you're not getting those prices anymore. I mean, we're almost, I feel like we're at a 2019 market right now, literally day to day. I mean, I could be wrong. It might be, it's hotter in some places. It's hot up in Milwaukee, but I truly believe that we've kind of reverted back to 2019 right now, which wasn't great.
I'm seeing a lot of prices for houses currently that were listed a year ago. Maybe they tried to sell it 2 years ago. They're trying to sell them now. And the price that they're listing is not far from 2019 or 2020 prices. Right. And it's not doing any. I mean, we're still seeing the market is so soft that if you're not pricing that house right out of the gate and you're not getting it under contract within 3 to 5 days,
you're sitting.
Yep, and you're seeing that too.
Absolutely. Yeah. I mean, we're kind of joking in my office. It's like, all right, we got a week to sell it. And if you don't, you're in for the long haul, which might be 2-3 months. And then you're sitting there going, okay. And a lot, what I'm finding too is like, you're like, I don't get it. Like, okay, it didn't sell. We had a couple showings, but it makes sense on paper. And that's one thing with the BPOs that I'm finding is that my actives are below my close now, which was a big deal back in like when I was doing BPOs in like 08, 09, the actives are starting to fall below the close now. And that's when you know that, okay, the whole thing's starting to move in the other direction. I mean, we're not there yet. I mean, you can't see it on paper. You got to kind of be digging through this stuff like I am. You can't just Zillow it and see that. It's like everyone thinks it's still great, but I'm seeing the actives and the reactivations. The reactivations are big right now. and getting a lot of questions on deals like, well, wait a minute, what, yeah, he's putting 25% down. Well, we need repairs done. The lender wants repairs done from the appraiser. I'm like, 25% down, really? But that's, you're starting to see that. And like those BPOs, when I go into those, when I look at their mortgage workouts, it's like, it makes sense because now he's at that cap, and they're only supposed to give him up to 70% of money. All these workouts are supposed to max out at 70% of what the property's worth. And that's why I think they're sending me in there, because I think they're getting like, well, we don't really know what this is worth today. We better have it checked out just to make sure, But even that's deceptive, because I may not have good comps to get it to where it may not show that it's worth less, even though it is, because it's not something I'm listing. This is just I'm just pulling numbers off the chart and I'm putting them together, and this is what it's worth,
So that's my next question. I had, there's a video we're releasing on Thursday, and I sat down with an appraiser, and he was telling me the pressure to hit the numbers. When a lender is giving you back, there was a lot of collusion, back in prior to the GFC, with appraisers or lenders picking the appraisers that would hit the number for them. And that's how the appraiser gets their work. If they're not hitting the number and the deal's falling apart and the lender's not able to get the loan, nobody's getting paid.
Right.
So what happens is this appraiser says that if he's not hitting those numbers, even today, in a lot of ways, and it's a great video, I encourage everybody listening to watch it Thursday evening. But if the appraiser's not hitting those numbers or can't find the comps, can't make it happen, this particular appraiser said that it could be 6 months before he gets another call from that lender again, because so the pressure is hot to keep. We just talked about how the servicers have to pay at auction the value for the property, not what the property is, not what's owed on it, for the bank to recover their loss or their potential loss. The question for you is, you just said you were able to get those numbers, even though you think that it might be worth less than what you're putting down because the comps are supporting it. What kind of pressure is it for a broker to, when a bank is calling you for a BPO, what kind of pressure is it for you to put the highest possible number on it, or you risk getting any more broker price opinions?
Well, I'll tell you what, who the pressure's from is the BPO companies, the BPO houses. It's not, you get some, because they'll send them back to you and they'll go, hey, we found some other comps over here. I always tell them, I'm like, look, man, I've been doing this since 2007. Okay. I know exactly what's going on here. And I don't, but half the time the comps aren't even legit, but it's like, and another thing they'll tell you too is they'll go, well, we have a BPO from 3 months ago that someone else did, and it was at this. I'm like, well, I don't know how he came up with that. And yeah, it's funny though, the BPO house, it's funny you bring that up, but they're the ones that are like, sometimes I'll get them back, like, question me about price. We think it should be higher. And it's like, well, why would you want that? So it's never gotten out of hand where it's like, get rid of this guy. I've always gotten same work from the same company, but I don't know. Yeah, a little tricky there.
So the BPO companies, they're the ones that are hiring you, essentially. So the servicer places it with a BPO company. The BPO company has their round robin of people that they've either worked with or that are qualified to do the BPO, and then they maybe they pick their favorite if it's in an area. Is that kind of the way it works?
Yeah. Well, basically I'm like a preferred vendor with a couple guys, a couple of them. So they send them right to me. I get them no matter what in this area within 5 miles or whatever. And as long as I turn them in on time, I keep up with their certifications. It's all good, But yeah, a lot of them, like some of the companies, like I told you, I get like, 20, I think I had 27 BPOs today, solicitations, that they just blast them, and hey, whoever can get on there, and you still have to be certified and be in their network, but they'll just blast them and someone else gets them. And I don't, there's some that'll assign it to you because you do good work for them, but a lot of them are just, we blast them. We don't care who's doing it, and a lot of those are just fighting price, we'll offer it to you for 50, $40 or whatever. And, I just want the quality ones. I don't want the crap, but I do want the ones that I can mail and say, hey, if you're in trouble, give us a call,
What triggers the BPO? At what point in the in the process, how delinquent does someone need to be before they order a BPO?
3 months is the last I checked. It's 3 months. So when you're 3 months behind, it triggers a BPO, a drive-by. And I get a lot of, they call them client refresh. That's the new words in the mortgage workout era, because they want to keep updating the price on it, make sure they're not giving away the farm to the guy. But that's why now with me going into these interiors, I think that's where, it's getting more, they're starting to batten down the hatches on it a little bit, because they don't want to end up completely fried on it, which I still think they're going to anyways. I don't, all this monkey business with, evaluations and more BPOs and, the bottom line, they've never seen even if I send them a BPO, there's stuff with that property they're never going to know about, BPOs, I don't inspect the roof. I'm not up in the attic,
I want to pull up a couple photos of slides that you took when you were at the conference, and maybe you can just kind of tell us what we're looking at.
Yes, the majority of, this is from HUD, majority of VA borrowers, DTI 43%, greater than 43%. That's pretty strong. That's like half their money going to that. And when you factor in a mortgage, they don't factor in taxes. They're, when a guy makes $100,000 a year, he's not making 100. It's not like here's 100 in cash. Okay, he might be making after taxes and all that, what, like 75, 80, especially in this day and age. So that's 43%. That's a lot of, and they're giving them mortgages, as much as they can. Hey guys, you qualify for, a $6,000 payment, even though the guy's like, wait a minute, I can only afford $3,500, but they'll give him whatever he'll take on, But yeah, I thought that was interesting. 43%. That's pretty high, to be into anything for. Yeah, there you go. Loan bottom line there. Loans originated in 2022, 24, 24 will be drivers of REO inventory in 26, 27. And that was brought up in multiple workshops for that. That's HUD.
So loans originated in 22 through 24. And I'm kind of surprised at that, because I would think that would go back to 21 and even to the end of 2020.
Right.
But by 22, we really hit the peak of home prices.
Right.
That was the mid 2020 through March, April of 2022. We saw the most exuberance.
Right.
Are they saying that the primary driver is interest rates because mortgage rates went up?
Yeah, I think that because they paid the most, these people pretty much paid the most. They're, they were over list price, probably more than half of these, I'm guessing, and I think a lot of people bought, when the rates went up, they were still buying. When was the rate like 7.5? Wasn't it like 23, 22?
Yes. Mm-hmm.
So,
23.
and you remember the old, date the rate,
hit 8%.
The property. And that's where I think these people are going to get sunk. Because what I'm seeing too is a lot of my lender buddies are saying, this one guy asked him, I'm like, what, where are you getting all these refis? He's like, they need money. So these people are refining into a higher rate just to get money out. That's a no-win, almost guaranteed. That'll fall apart eventually. I still think there's a lot of pain in 2021 too. 2020, 21, even 2019. They stopped foreclosing in 2020, and I know there's still properties out there that are, still sitting in the system that these people have been, barely paying since 2020, but there's no foreclosure pain.
You know, it's interesting here, high mortgage balances, high mortgage payments, and little equity cushion if prices soften. Prices are softening,
Yep.
as well as the end to many COVID-19 forbearance programs will be the prime drivers of the 26-27 REO inventory. So they're setting this up. They're basically saying
Yep.
that 26 through 27, we're going to see a lot of foreclosures.
Yep.
Who do you think the foreclosures are going to go to? Do you think this is going to be inventory that hits the retail market? Or do you think that they're going to do like what they did back in 2009, 10, 11, where they're continually bundling these mortgages and selling them to Wall Street type companies?
Yeah, I don't. They're not gonna. Well, I will see very little through my portal just because they're, Fannie and Freddie they're gonna auction them. They're doing it now. They're sending those to those, those pools, and they're getting rid of them that way. They don't want to look bad. The government's trying to be like, hey, it's not our fault. There's no, everything's great. If they ran those through which they should run those through foreclosure, because if you did that, it would be more inventory. Okay, give the guy a chance. Again, I have to reiterate. It's like they think you're a bad guy. You just want to throw everybody out. Give him a chance, work it out. But you get to a point where the guy can't afford it. Period. Done. Over with. Game. Set. Match. Time to foreclose. Boom. They get the property back. Paint, carpet, whatever. You got a new buyer. It's a new dream for somebody. You know what I mean? And it's like, yeah, but they're going to keep pulling them because they don't want to be like, oh, Fannie's got all these foreclosures now. That looks bad,
When somebody files for bankruptcy and they're living in a house, what does that do for you as an agent, a broker that is moving forward in helping the bank foreclose that asset? What do you have to halt everything you're doing at that point?
Oh yeah, it's over right there. As soon as I had one of those in Naperville, Illinois, and we went to evict him, and he filed bankruptcy. And he was standing outside with the sheet. Look, man, see ya. Have a nice day. We're like, let's go. Yeah, it freezes everything, and that can buy them a year, especially in this state. I can buy them lots of time. And that's kind of what is going on. It's just that's why, like I said, those bankruptcy attorneys are calling on me for that now. I mean, that's almost that can be a full-time job. The way the pace is going with how many solicitations I'm getting. In 6 months I might have to have somebody doing those because it's getting that interesting with those. But yeah, if somebody files bankruptcy, all bets are off, and if they do it before the foreclosure, that buys them all kinds of time, especially here, like I said.
So they could live in the house without paying for 2 years, file for bankruptcy. It could be another couple of years.
Oh,
before.
Yeah, absolutely.
Gotcha. A lot of empty seats there.
Yeah, it was not, it definitely wasn't except for seeing your buddy. It wasn't, I saw a couple people I knew, but yeah, it's just, there's nothing, people aren't going to put the expenses out to get that. I just wanted to go and see and get it, I learned enough to be dangerous, like with the 2026, 2027, stuff like that. I just wanted to get an angle on what was going on. I figured out that Equator and REO Network and ResNet, they're all just pumping agents for dues. And, it's like, okay, nothing new there,
Yeah, and a lot of agents are probably thinking that that they're going to get busy with foreclosures. And I think, let's pull the poll back up. I kind of am coming from the camp personally where I don't think that they're going to hit the retail market either. I think that we have a situation on our hands where they're not going to want this publicized.
Right. The only way, though, the only way is if it completely bombs out, which I am absolutely not ruling out, is if everything just bombs out, where they have too many to deal with. Then it's going to be like, well, like they did in 08. They go, well, Fannie and Freddie were just this, one building, a couple buildings shop that, but when everything hit the fan, they had to put facilities in different states. They had to hire on 10,000 agents to deal with the mess, and I look at it like, stay tuned, because yeah, I could see this being a complete burnout coming up with the jobs, all this job stuff. I mean, look at they didn't even do a jobs number this month. Thank God they didn't. I mean, the administration's like, oh, thank God. Good. No news is good news, because it would have been worse. But this thing hasn't even, wait till all these factors start banging into each other, and I just, right now they can pool them, get rid of them, no problem. But when everything gets really bad, they're not going to have a way out of it. And that's all these workouts and everything, because you won't be able to save somebody whose house just dropped 40 grand in 6 months, which is what, 08, that's where everything just cascaded at once. And I am not ruling that out right now.
You think we could have another 08?
Yeah, I think it could be worse.
I think we could have more than 4 million foreclosures in the
it's
US.
Not even a foreclosure thing, though. It's more of it's an everything thing. It's like, I could see it being much worse. I mean, I just think there's, it's like all these investors that are buying all these properties, and that number's up too. They're starting to buy more and more. And it's like, they haven't felt the pain either, but a lot of them are all just money that's, they have these, loans, pools that are, if people just go, I can't even rent anymore. And then you have more people living in one house, that's going to crash them too. I mean, it's just that everything's teetering on the brink. And it's like, people are only going to pay these, ridiculous prices for so long before they just throw in a towel and walk away from it. Can't afford to own it, can't afford to rent it,
There's a CBS News article that published this morning. It's talking about some homeowner that Kimberly Draxler was in shock when she called her mortgage lender in April and was told her 4-bedroom home in Hillview, Kentucky will be sold out from under her in a matter of days. But the article goes on to say that although foreclosures, which include default notices, scheduled auctions, or bank repossessions, remain well below their pre-pandemic levels, obviously because of the moratorium and all of the workouts that we've seen over the last 4 or 5 years, that foreclosures are on the rise. As of August, like you were saying, foreclosure filings had risen 6 straight months year over year and were up 18% from the same period in 2024. And that consists of, through June, roughly 188,000 properties have foreclosure filings, putting the U.S. on track to surpass the roughly 322,000 that went into foreclosure in 24. You can look at this chart here. You could see that through the prime pandemic years of 2021 and into 22, they were historically low. And you could see prior to that, even 2018, I mean, still much higher than where they are right now. And obviously we know that is because of what you've been explaining, these continual workouts and not foreclosing. Right. People leaving their houses, then being afraid to foreclose on them or change the locks because they could have some type of criminal implications of an illegal lockout.
Hey, Todd, it's like, too, I love how it's like, we're still way below pre-pandemic level. Well, in 2018, 19, we didn't have all these people getting workouts. That's what I mean. It's all deception. It's just, oh, well, we're still good. Foreclosures we're below pre-pandemic levels. But you're not looking at it's the tip of the iceberg, man, and all this mess is behind it. And that's the problem with it. It's like, oh, but John, foreclosures are still way down. It's like, yeah, but you're not looking at the people that aren't making their payments.
Let's take a look at this. This was an article that you sent me. Foreclosures hit 35K, activity up 18% year over year. Let's look at this timeline. August of 24, foreclosure activity stood 18% below the August 25 levels. Homeowners face fewer starts and completions. May of 25, home price appreciation slowed. Year over year gains moderated across major price indices. July of 25, total filings dipped 1% from June. August 25, filings totaled 35K. Nationwide rate stood at 1 in almost 4,000 units were going into foreclosure. But look at these, the highest foreclosure rates: Nevada, South Carolina, Florida, Metro highlights: Lakeland, Florida; Columbia, South Carolina; Chico, California; Cleveland, Ohio; Ocala, Florida. Top states by starts: Texas, Florida, California, New York, Illinois. There you are.
Mm-hmm.
New York, Houston, Chicago, Los Angeles, and Miami.
Yep.
Top states for completion: Texas, California, New York, and Florida. Illinois, you're in there again. Chicago, top metro area. So that's why you're busy.
Yeah. I mean, yeah, and it's the BPO world right now we're in. It's not, then that's what it was in 07, 06, 07, 08. I was doing a ton of BPOs. It was like, and it was hot, and that was before everything hit the fan,
Let's take some comments. All that government assistance is ending. It stands to reason home prices will come down now unless other helpful government interventions come along and inflates it all over. So do you think that part of the foreclosure process not really happening, and what we have seen with the loans that have been in default, Fannie and Freddie, they've been auctioning them off, that's not really hitting headline news? Do you think if we saw more retail front houses foreclosures hitting the MLS, do you think that will escalate the home price declines?
Oh, for sure. I mean, but they're going to, like it said, a helpful government intervention comes along and inflate. They're going to blow as much hot air in this bubble as they can, because they don't want it to, what good is it, that's why I said, like I said earlier, it's like, what president's going to go, hey, it's going to be painful for a while. Nobody wants to do that, because in 4 years they're out of it. Again, it's not political, but yeah, they're going to intervene as much as they have to keep the whole party moving. If they keep pouring it into the punch, the party will keep going on, but that's why it's like, there's certain factors like the jobs, that will eventually take its toll on the system where you can't do anything about it anymore.
Kathy Ains says, I always hear you don't want to get involved with a foreclosure because a lot of times the buyer was angry and they lost it, and who knows what damage was done. Not to mention you can't inspect prior to purchase. So what she's talking about is buying the foreclosure and seeing something that says it's unlawful to disturb the tenant. You can't go on the property.
Right.
So a lot of people back in the '08 crisis, a lot of investors would stand at the curb with their binoculars and they would try and inspect the house as much as they could.
Right.
And the price that they were offering back then was so cheap, and they were getting it, that they didn't really care what the homeowner did inside. They were just planning on a complete gut job anyway. I will tell you that is fine so long as you don't have a private water source, a well, or a private septic.
Yeah.
Because they can destroy that, and that can be, you don't even know how much that could cost.
$30,000 for a septic probably.
Could cost $30,000 for a septic system, and you may not find another well. I've had people, drill 4, 5, 6 holes on a property trying to find another water supply that met the county, yield requirements, and sometimes you just can't find it. So the caution out there, I caution anybody that's buying these foreclosures, if they have a private well or septic, run away.
Right.
Because somebody that is angry can do some major sabotage to those systems.
Oh, yeah.
So frustrating. I've been waiting to buy a house for a year now. I'm worried if I wait longer, it will be less and less affordable. What's your opinion on this, John? You think we're going to see major price declines throughout the U.S.?
It's coming. It's just, you got to be patient. I have relatives that are trying to buy right now, and they're looking at stuff going, I told them, be picky, just wait. They don't have to move right now. So it's like, give it 6 months, give it a year. You're going to see this stuff starting to filter down into the system. And, like I said, low appraisals coming in, low sales coming in. Those are going to start driving those resales down. just, you got to be patient. You know, if you're hell bent for leather and you want this house at that neighborhood, at that address, then just go buy it. As long as you don't have to move for 3 or 4 years or 5, you know, but yeah, just go buy it. I mean, it's your home. If it's what you want to live there, then go do it. But don't be, you know, well, I'll stay there a couple of years and then move. That would be risky.
Phoenix Rising, the people who are in trouble with their homes are the same people driving cars they can't afford with $1,000 a month car payment. So many people in that category, house of cards.
Absolutely. Yeah, the cars, I mean, what did I see the other day? The average car payment in 2019 or 2020 was like $475, and now I think it's $750.
Sheila, thank you so much for your super chat here. Sheila Grace, good to see John and the raw truth. People love you, John. Every time we have you on, and you get a lot of inquiries too. People reach out to you when they see our show.
I do.
Housing in the U.S. is a casino propped up on mortgage-backed securities, Wall Street crackheads. Everyone loses. Nothing gets resolved, and a GFC 2.0 is now in full motion.
Yep. See you there.
See you there.
Man.
It's funny because the heat that we took in 22, talking about the housing market crash was coming, we certainly couldn't foresee just how it would be continually propped up. But one thing that we knew for sure was that it wasn't sustainable.
Right.
We knew it
was coming.
You knew it was coming. Right. I mean, the exuberance was unbelievable. Anytime you pump that much hot air into a balloon,
right,
it's only a matter of time before it pops. And it's popped. I mean, I'm telling you, we are in a market right now where if inventory isn't move-in ready and it's not priced to sell, it's sitting. Our hottest markets here in Maryland, price reductions, back to actives, the homes going under contract, they're doing their due diligence, having their inspections, the seller's not willing to make repairs, and in a lot of cases, or repair what the buyer's asking for, and they're going back on the market. And this is happening. Prices are declining. I had somebody say to me the other day, they said, but yeah, isn't October one of the hottest months historically in the housing market? And I would say next to April, May, and half of June, October historically is a busy month. That's right before the holiday season. We're seeing people coming back from their vacations. They have their kids back in school, or maybe a lot of these first-time buyers have graduated. They got jobs. They're now in a position where they want to buy a house. And so, historically, October's a great month, and our sales are reflecting that. I mean, we are seeing a definite uptick in transactions.
Market times, too.
What's that?
Market times, too.
Yeah, exactly.
Those are creeping up.
Yeah, but it's still extremely slow. So when we're looking at it, where do we go from here? Well, we're going to nosedive. We're going to hit November. Thanksgiving's right around the corner. Then you have all the holidays, and you're not going to expect to see consumer activity at best till after the first of the year. And so what's your prediction of the spring market? You think it's going to be a fiery spring market like a lot of these housing market analysts are saying, like, oh yeah, the end is over? You're just telling us it's just our foreclosures are ramping up.
Yeah, the spring. I mean, it's like I've been saying, middle of next year to late next year is when you're going to, spring's going to be the people that have to move, that want to move, that have a family, that, that'll be there. But no, that's when all the pain is going to be starting to kick in, that people don't even realize where that's going to trend to. I mean, it's just, you just got to watch it play out. I mean, that's kind of the problem with it, and, like I said, if you want to buy, if you're going to buy, you got a plan, you're going to be there for a while. It's, it's like I told my client, I said, your 2-year-old's going to go to high school there, buy it, but don't be speculative and do silly stuff like that, which, you still get that. But yeah, spring. I mean, this thing right now, really the last like 2-3 years, it's been like, you don't even know what's hot and what's not. I've had busier Decembers than April in the last couple of years. It's just weird, it's weird, So,
but when we talked, my friend, several months ago, you were telling me that where you are, Illinois, is still hot. And the last time we spoke, you said, yeah, it's finally hitting us.
Yeah, it is. It's hitting now for sure. For sure.
I have a question.
I look at the 250 and under in Kane County, which is the county we're in. And it's up, it was 42 units in May or whatever it was May. I think 42 units. Now it's 82. It's like, okay, that's almost double and that's under 250. That's not like 600, 800. That's 250 and under. That's like the hottest stuff you can sell right now, Anyways.
That's Jungle Book has a question. What's the best option for buying foreclosures?
Man, you got to do your homework. It's not for the faint of heart. It's not for somebody who doesn't know what he's getting into. There's places like Hubzoo, auction.com. You can go on and buy them, but they're usually occupied. You're buying sight unseen, dealing with unruly people that have been there for probably 2, 3, 4 years without paying. You got to get them out. You can buy a Fannie or a Freddie, or you can buy a HUD, and they give you an inspection period. It's not they'll give you the inspection period. No worries. I mean, just go. That's probably your best bet if you're not savvy to home repairs and stuff like that. And the biggest thing to keep in mind is the cost of this stuff now. You need a roof. Roof used to be $8,000 on a ranch. Now it's 16. And that's what, a lot of people I don't think realize what stuff costs. I mean, a furnace, AC, and a thermostat are $12,000 now. That used to be 7 or 8 back, 3 years ago, 4 years ago. So that's the biggest thing. Just know what you're getting into.
Yeah, I don't, Joe, Riley, if you could share my screen. I don't know if you can, the HUD home store. Yeah, I want to pull up what John's talking about here. The best way to buy a foreclosure would definitely, in my opinion, be to buy a HUD home, a HUD-owned home. They've already gone through the foreclosure process. And the nice thing about it, and I guess the question, getting back to Jungle Book's question, is understanding whether you want to buy a foreclosure to actually, thanks, Riley, to actually live in it yourself, or whether you want to flip it as an investor. I will tell you that any investor right now, a lot of the inventory that I'm looking at locally here in Maryland, and I would probably venture to say it's pretty consistent throughout the country. We have historically been one of the best markets in the U.S. because of our stable job market here. Well, right now we're experiencing a government shutdown, so it may not be, the case today. But what we experience here is we have a very strong job market. Our 2 largest employers are the government, and that would include government contractors and insurance companies, which is a very stable job as well. But the problem, and right now I'm looking at a lot of the inventory, is investors. If you're looking to invest, you don't know what the resale price will be. It's a moving target right now. It's very risky. So when you're looking at buying a house that needs to be renovated, you're looking at something, going through the permit process, hiring the contractors, doing the right job, then getting it marketed, put on the market. You could easily be 3, 4, 5, 6 months, depending on how good you are doing it, before you put it on the market. A lot of the active inventory right now that's sitting the most is renovated inventory, renovated inventory. The investors are losing their butts. And so what happens is, if you're doing it from an investment standpoint, the price that you pay on the purchase is the key. It's everything. It's the Mac Daddy. You can only do so much. Your renovation costs are going to be what they are. So your profit lies, your ability to profit and your cushion relies on the purchase price. Now, I have been trying to buy a flip myself because I've been a contractor for 35 years.
Me too.
I want to bring the process to my viewers, from the walkthrough, from the purchase to the renovation process to the marketing and sale of the property. I want to bring my viewers through that entire process for a couple reasons. Number one, I want to show people that it's not that hard to buy a distressed property if you can get the financing for it. to do it yourself. And that's where you can make money. But if you're going to do it to flip or that's where you can do it to save money if you're going to live in it. But if you're going to flip it, your profit right now, you have to offer such a ridiculously low, shocking price for the property,
Right.
or it's not worth it. And the problem is that the consumers, the sellers aren't ready for that shock. So that $340,000 or $360,000 house that's worth $200,000, you put an offer for $140,000 or $160,000 under list price, and they're going to laugh at you.
Right.
Even though that is probably where you should be. So you have to monitor the price. You have to find a way to save the property depending on what platform you're on. Get your alerts on it. Maybe communicate with the listing agent and tell them it's way overpriced, but I am willing to make a deal. If we get down around this number, they'll laugh at you, and then maybe one day they'll call you back.
Right.
But I wanted to show this website because what John had suggested is HUD Homes, they'll finance these properties for you, which is even better. They'll give you renovation loans. They're going to work with you like probably no seller will that's selling a distressed house. And basically, you could just put in your state, your area, whatever. And then what'll happen is it will give you your options. It will come up here with a map. There it goes, it's loading. So there's your map of available houses. And what you have to know when you're on HUDHomestore.gov, what you have to realize here is there are two types of listings, really. One is an exclusive period for 30 days when most properties, I have seen it where they just put it on as non-exclusive, but very rarely. Most of the properties are going to have exclusive period. It means for 30 days, owner occupants can buy that house. And you're going to sign affidavits. So if you're an investor that wants to be dishonest, there could be criminal prosecution should you
just saw one of those.
Yeah, and they'll do things like see that you registered your driver's license to the property. I mean, you got to keep it for a year.
Right.
There's a lot of things that you need to do when you're signing these affidavits. But basically, once it's open to everybody, so this first one here, you could see it says listing period exclusive, owner, occupants, nonprofits, and government agencies only. Once it's opened up, it will say listing period extended. And there's a process of how to put your offer in, but it is a very easy way. The government will work with you if you're an owner occupant and you want to buy that property and do a renovation loan. They will allow you, like John said, the chance to see the house, do your inspections, get your prices of renovation. There's a process to do it. You could reach out to me. You could reach out to John. You could reach out to HUD directly. But this is a good option going back to the question, what's the process of buying a foreclosure? I'm telling you right now, dangerous proposition to buy a occupied property. You are responsible for evicting those people. The eviction process, depending on the state, is very cumbersome. There is a lot of legal requirements. Maryland just passed a new law, October 1. Now a landlord, and you become the landlord. They're an occupant. Maybe they're what's called an unlawful detainer. They don't have a lease. Sometimes people make up leases. They say, I have a right to be here. You have to go through the whole eviction process. It's messy. Gruesome. And now in Maryland, and I'm sure other states as well, you have to actually store their furniture. You used to be able to show up on eviction day. The sheriff will tell you how many people you need there, what moving company, 8 guys. You have to pay a minimum charge, whether they're gone or not. They have to show up so they verify that you have your moving crew. You have to have a locksmith there. You can't drill the locks yourself. It has to have you have to have a locksmith. And then what happens is you evict the people. You could put all their belongings out on the front lawn, and they had 24 hours to pick it up. And if not, you were required to then have a dumpster company or a junk hauler remove all of it. It couldn't plague the neighborhood with junk in the front yard of a house for days and weeks and months. You had to get rid of it in 24 hours. If in 24 hours the occupants didn't pick up their stuff. But what happens now is you have to move it to a moving storage facility. You have to pay for the storage. You have to give them a period of redemption. And then if you sell the merchandise, you have to give the occupants the profit above what they're owed. So when you're evicting people,
What
it's
could
no
go wrong
fun.
there?
It's no fun, right? I mean, John,
What
you know
could
what I'm
go
saying?
wrong there, man? Wow. It is. It's crazy. I was going to mention too, FHA 203K loan. That's a good one for your guests. If they're like not a totally handy person, they get to hire their own contractor. It's got to be licensed, and he can run the whole show to put that house back together for you.
It is a pain in the butt, though. It is
It
very.
is. Oh yeah, it is. But that's one way to do it. You know?
And if you have a conventional seller, not a foreclosed property like a HUD-owned property, the problem is the seller doesn't want to wait because it could take 90 days, 120 days to even close on the loan. So a lot of sellers don't want to wait for that. You can also do a conventional renovation loan, which you can finance. You could put a swimming pool in. And a lot of people don't realize that. I teach it on my Todd's Simple Home Buying course where, there are all these different loan products that you could take advantage of. But doing any of these renovation loan mortgages, the problem is that, the contractor, number one, finding a contractor that is licensed. And number two, they have to break out the labor and the material costs separately, which is a pain for contractors to do.
Oh yeah, it's not easy, that's for sure. But
they have
it's
to
there.
Itemize everything.
We don't do a lot of those, but I do see them here and there.
Yeah, they do exist. I think we'll see more of them come back now that sellers are having a hard time selling and they don't have the money to make the repairs. So that's a good option to say, hey, you have my inspection report. We don't have the money to do the repairs that you're asking. We can wait if you get a renovation loan, and maybe we can work on the price, a better price, and we can wait for you to get your renovation loan financing in place, and we're okay with settling in 90 or 120 days.
Right.
All right, let's see what else we got here. I wonder how much of that money not going to mortgage but going into the economy is, and how much it will affect the economy if they had to pay bills instead of purchases.
Yeah, that's why it's all hot air, man. It's all been cranked up, and you don't really. I mean, they look at the student loans. You have to pay those for 4 years, 5 years, and now it's all coming due. That's what I mean. The whole system is coming due.
Clark says, yes, the progress is being drawn out. It is horrible that people are losing their homes, but people have been willing to pay, or at least have to be willing to pay, or at least try. Most are just sitting in the home without paying. And that's kind of what I have found, John, don't you? I mean, they know they're going to lose the house eventually, so they're just pocketing and saving the money to have cash for the next move.
Right.
I work at a pretty big real estate firm in Florida. In the FC department, we received about 10 referrals daily for the past 4 months straight. No days missing. Tough times right now.
Yeah.
My husband was interested in purchasing, but I told him to wait, and I've been watching you guys just to be updated on what's happening, boots on the ground. Thanks for the coverage. And that's another... And thanks so much for the unseen oracle here. We are boots on the ground. When there are a lot of channels that are out there, and I'm not knocking them, but there are a lot of channels that are covering the real estate market, and they're not actively, they're just looking at headline news, maybe listening to other people, but they're not actively out there helping people buy and sell houses and properties. So we are seeing it from a firsthand
absolutely
basis. And then Charlton Zimmerman, what's up, Charlton? Question: can you get a loan on a bought foreclosure property?
Not without getting into it. I mean, no lenders. They're not going to lend you money on a property they can't see before you buy it. Usually those are cash. I mean, those auctions, I've sold them at auction for the banks, and when they're occupied, it's sight unseen. They're cashed. I've never seen one with a loan by one that's occupied by a former owner who's not paying. They don't. The banks want to know most of the time what's going on with the property.
They need an appraiser to go inside.
Yeah, right.
It's interesting. This video that we have coming out this Thursday, John, you're going to enjoy it. We have an appraiser that he really is giving. He's telling all on what's happening. He's been an appraiser for a very long time.
Is he in Maryland?
No. Is he in Ohio? I think.
Oh, wow.
Yeah, he's in Ohio.
That's busy over there. I'm thinking that's getting pretty busy.
Yeah, but one of the things that he said that's kind of surprising is the amount of basically appraisers need to be home inspectors now.
Right.
So they have to look
before,
at
right.
they had this huge form now they're going to have to fill out, and they have to give values or condition reports on so many different points of the house. The flooring, for instance, the cabinets, the appliances. So they are on the hook, or will be on the hook. And by the way, the pressure is pushing down on them to do everything cheaper. And, I guess same with the BPOs. They want you to do them for the least amount possible. They want to hire the cheapest, but they want to get the best analysis. And so that is going to be, I think people are really going to enjoy that video.
That's Thursday's show?
Yep. All right. Well, John, anything else you want to add to what we've been talking about here, buddy?
See you in 12 months. It's coming, man. Stay tuned. I'm telling you right now, it's like, just be patient. There's too many irons coming out of the fire right now that are not going to bode well for this down the road, for sure.
All right. Well, we shout out to the Instagram viewers. We streamed for the first time on our Instagram account. We figured out how to do that. And that's something that we will include in our weekly live stream. For those of you that are watching, if you want to follow us on your favorite social media channel, we're everywhere that you can possibly look there. We also have our audio podcast where this podcast will be posted. And you can get that on all of your major audio streaming channels as well, whether it's Podbean or Apple or Stitcher, Pandora, you name it. We are out there. So there's all kinds of ways that you can get our content. And if you like this video today, you can let John and I both know by hitting that thumbs up. And we also now have a way for you to support our channel for $2.99 a month. It will be a big help in us continuing to provide content, great up-to-date content pertaining to the housing market and mortgage rates and anything else that pertains to real estate. So we'd love for you to have an opportunity to do that. You can cancel at any time. And John's links are also in the show notes. You can cruise over and check out his website. And if you need something that he can help you with, if you're in the Chicago area, reach out to him. He's also given a lot of information to agents that want to know, how do I tap into this foreclosure market? And he's given some good advice to agents along the way with that as well. And if you want to buy foreclosure in John's area, hit him up.
Yeah, I survived the BPO onslaught of all the agents wanting to get on that. I spent about 3 weeks just wielding calls, and emails and whatnot. But I did get a couple of agents reach out saying, "Hey, man, I got it up and running." I'm like, "Okay, we'll make it." Oh, yeah, it was
awesome.
good.
Well, that's good stuff.
Yeah.
All right, my friend.
All right, bud. Good to see you, man. Thanks for having me.
Good to see you. I'm sorry I had some massive FOMO when you and my buddy were sitting there in class and sending me pictures. But anyway, all right, my friend. Well, it's always a pleasure, John, and we'll be talking to you soon.
You bet, man. Take care.
Okay.
We'll see you.
See you.
Sachs Realty, Maryland broker number 607720, office number 443-318-45